Very good evening to you all, friends. I am Sanjeev Singhal, Central Council Member, Chairman, Auditing and Assurance Standard Board. On behalf of the Institute of Chartered Accountant of India, on my behalf and behalf of my Vice Chairman, C.A. Vishal Bhai Doshi, I welcome you all to this very important webinar on CARO 2020, Practical Issues and Challenges. Friends, we know that the revised CARO is applicable from last year. And now there are about 50 clauses, sub-clauses and sub-sub-clauses. And the whole CARO has undergone a lot of transformation. There are many regulatory reporting requirements now, and many of them are quite onerous, due to which the Institute of Chartered Accountant of India impressed upon the Ministry of Corporate Affairs that there should be corresponding disclosures in the financial statement as well. And the same was acceded to by the MCA. And the Auditing and Assurance Standard Board last year also comprehensively revised the guidance note on CARO. We have held various workshops and webinars and seminars last year, and we thought that this will be good to refresh the key provisions of CARO 2020 in this busy audit season. While the listed company audit season is already over, in fact, today is the last day for declaration of the results. Now the unlisted company audits are in full swing. So this will come quite handy for our members, and you'll be glad to know that this is the 88th program of the Auditing and Assurance Standard Board in this council year, which is about 3.5 months from when it started. And friends, we have also started an expert helpline whereby you can also ask questions relating to auditing from our experts, and these are free of cost. To deliberate on today's topic, we have CA Pankaj Tiwari ji, who's a director in C&K and Associate LLP. He is a chartered accountant who qualified in May 2012, and he has a rich experience of audit as well as the other areas of professional practice. He has also contributed one publication on significant audit matter for the Center for Audit Quality, and is a regular speaker with the Institute of Chartered Accountant of India. We thank you, Pankaj, for joining, and would request you to kindly deliberate on the topic. Thank you.
Thank you. Thank you. Thank you, Sanjeev. I'll just share my presentation. Institute team can just confirm whether they can see the presentation.
Yes, sir.
Okay. Thank you so much, and it's a privilege and honor to always, come in front of the members to speak on a topic which, as Sanjeev sir has said, it is very important. It is important more from the perspective since the listed company audits are over. Now we will be busy, or we'll be getting into the audit of an unlisted company, which are a small company, and where all our small time practitioners have an onerous responsibility to fulfill. So last year, as we have been briefed, the last year the CARO 2020 was changed, and currently this is the second year in running for CARO 2020. So obviously it's a good time to look at it. What were the clauses which were introduced, how we reported in the last year, what are the issues which came up in the last year, how many companies which are listed on BSE or NSE have reported in the in their annual report in the previous financial year. So the flow of presentation will be like, I'll be just discussing briefly about the changes in the CARO 2020, just to refresh and set the context of the presentation. Then we will be discussing about some of the recent changes which have happened during the year, which one should be careful about when they are issuing the audit report. And we also will be dealing with some of the specific clauses of the CARO 2020, more particularly the clauses where there is no corresponding change in the Schedule 3, because that is where, as an auditor, we have the sole responsibility to report upon. So we thought that will be the best clauses to pick up, and some of those clauses are very important, very, very crucial clauses, and some of those clauses have been included as part of the regulatory feedback also. Then, it is always to learn from the mistakes of the others. During the course of my whole presentation, I'll be showing you some of the examples wherein how a particular entity has reported on a particular clause, whether it is right, wrong, we will be discussing upon it, how it can be reported. If such situations are in your company, how you should report upon, and that's all we will be dealing about. At the end, we will also be looking at the FRRB observation. All of you are aware about the FRRB regularly conducts the review of the financial statement. Until now, they have come out with many publications which are available in the public domain. It is important for us also to look at those observations and make sure that some of these errors or mistakes are not present in our audit report. And as a last point, we'll also be covering some of the important observations, or I can say points which are raised by the NFRA in their various orders which have been issued recently. So this will be my flow of a presentation, and we can start from here now. And whenever you people have any question, please start posting in the chat box. I think the institute will take care and we will address them at the end of the session. So all of you are aware about this is just a basic slide which says that as part of the reporting under the Companies Act, we are required to report under Section 143, which has various subsections ranging from Section 1 to subsection 15. And specifically talking about the today's presentation, we have Section 143.11 out of that 1 and 15, under which we report upon CARO. Basically 2020, it started with 2003, certain amendments, 2016, certain amendments, and then finally we have CARO 2020. All of you are aware about, the main format of our audit report. The main audit report is typically the format-driven report, right? Some changes here and there just to accommodate some of the qualifications or some of the emphasis of matter paragraph or the other matter paragraph. Section 143 subsection 11 is basically a statement which is included in the report. What this statement is, all of you are aware about. This statement has various clauses on which the auditor need to comment upon. Earlier, these were in the nature of the facts. However, we will look at it. Some of them have been changed to the opinion in the recent time. So this is the basic framework under which any auditor on any company reports upon. And this is the one change which I would like to spend some time because this is relevant for you. And whenever you are signing an audit report, this is one new clause which will get added in the current year's audit report. So we should be very careful about. One change is with respect to the audit trail. All of you are aware about the audit trail is applicable to the entities from now onwards. When I say now onwards, it is applicable to the entities from 23-24 onwards. And that is how the rule 3.1 has been suitably amended with respect to the company's account rules. However, Rule 11G, which is companies with reference to the Company Audit and Auditor Rule 2014, has not been amended. Now, that rule still says that this reporting is applicable from 1st April 2020-21. The institute promptly and in a very different way has come out with an implementation guide. I would request each one of you to look at this implementation guide, not from the current year's perspective of reporting, but from the subsequent year's perspective of reporting. And many of you will also be, making aware your client that what kind of reporting we have in the subsequent year. Now, there is an anomaly. The companies are required to implement this particular point of audit trail from the next year. However, Rule 11G says that the auditor need to report upon in the current year. So what the institute, I think with the discussion with the MCA, has come out with a para which can be included as a response to Rule 11G, which says that this rule is not applicable for the current year and hence it will be applicable for the next year. And that's why the reporting is not relevant for the current year. My friends, it is important to include this clause in the audit report. It is very relevant. Why? Because there is a corresponding Rule 11G which is already there. So if you don't report it, one may take a view that your report is not in compliance with the Rule 11G. So that is why one should be very careful in reporting upon, and you can take the institute guidance and report upon this clause in the audit report. This is just an illustrative format of the report, which I have put it on the presentation. One can take the exact wording from the implementation guidance, or can also look at the industry practice, how the other people have reported in the industry in their audit report. So this is how one of the entity has reported more or less similar, statement of more or less similar statement, which typically says that this is not applicable for the current year, and hence no reporting requirement is there. So make sure whenever you are signing any audit report in the current year, this clause should be there in your audit report, and it comes under the regulatory and other matter paragraph after the dividend clause. So this is one change which we should be aware about it, because this is the change which is different as compared to the last year. Now we come to the topic for the day, which is like CARO 2020. Now, many of you would be, would have reported in the previous year, would have dealt with various issues in the CARO 2020. Some of you would have also given negative remarks or negative observation on CARO 2020, various clauses. So quickly refresh on CARO 2020. What were the changes? The changes were very minimum, or the changes were like as follows. First, they had reintroduced certain clauses. These clauses were related to the internal audit, were related to cash, were related to short-term fund, which was utilized for long-term purposes. All these clauses were some or the other time were present in the CARO. However, they were removed from CARO 2016 and they have got added now again in the CARO 2020. The one main reason what I could think upon, specifically the internal audit clause or short-term fund utilized for long-term purposes. Internal audit clause, in recent past, there have been various instances of the corporate failures or corporate governance failure. One of the reasons which would have been identified or maybe identified, or that's the possible reason why this internal audit clause got reintroduced, that there are internal audit failures. Internal audit is the first line of defense for an external auditor. I mean, they are the one who is on the ground doing this checking or doing this verification on a regular basis. That is why this clause on the internal audit has got reintroduced now, wherein a responsibility has been casted on the stat auditor to look at it, the scope and coverage and the reporting done by the internal auditor. Short-term funds and utilized for long-term purpose. This is the purpose. The logic behind this is very simple. There were instances of diversion of fund, and I think through introduction of this clause, the ministry is trying to catch those kind of instances if present any. Now, they have included some of the new clauses which you all are aware about. As an auditor, now we are required to report upon the Benami Property Act. We are required to report upon the CSR also and on the working capital. Working capital is very much expected because the recent frauds which have been reported by the RBI are primarily from the, from the CC facility which has been taken by the companies. And you have inflated debtors, you have inflated stock based on which they utilize these limits. So this clause is fairly understood that this is coming directly from the Reserve Bank of India, and as an auditor, the requirement of the clause is also in line with the expectation of the RBI. There are certain clauses where there have been no changes. Like for example, earlier also we used to report on 185, 186. Now also we are reporting upon 185, 186. So there are various clauses on which there have been no changes. However, there are significant clauses where there have been amendment, and we will look at it. One of the change which the CARO 2020 also brought is reporting upon the CFS report or CARO implication on the consolidated financial statement. As you all are aware, in CARO 2016 there was no requirement to report on the CARO in the consolidated financial statement. However, I think the ministry felt, and even the stakeholder felt, that when I'm looking at the consolidated financial statement, if there are any clauses where, let's suppose, the statutory auditor of a subsidiary company has commented upon or has given negative remarks, as a stakeholder, as a shareholder, I need to go to the respective subsidiary financial statement to look at it. What are those negative clauses or what are the negative observations? I think CARO 2020 is fairly in that line that if any negative observation or negative comments which have been made by the auditor of the subsidiary company or the group companies, it needs to be covered in the consolidated financial statement. And we will look at it how various different companies have reported on this clause in our subsequent slide. And obviously, as Sanjeev sir mentioned in the beginning also, that all these responsibilities, the reintroduction of various clauses or introduction of the new clauses, first responsibility has to be casted on the management unless and until it is pure reporting responsibility. So suitably, the Schedule 3 has also been amended. All of you would have looked at it last year, and corresponding CARO clause has also been introduced. So at least you have some basis to report upon some information which has been already disclosed by the companies on which auditor can verify and report upon. And that was a primary reason for the delay in the implementation of CARO also. Now, this is nothing but a summary of the clauses for you to have a glimpse of it. There are 21 clauses and there are 47 sub-clauses. So effectively, when you are signing a financial statement or you're signing an audit report, you are not reporting on the 21 clauses. You are practically reporting on 47 clauses. And these 21 clauses primarily obviously have sub-clauses, as I said, have been divided into these three parts. As I said, there have been certain newly added clauses. And let me tell you, some of these clauses as an auditor, we were always looking at it. Like, for example, the clause on the internal audit, which has been introduced now. As a statutory auditor, it was always my responsibility. If there is an internal audit in the company, I need to look at it. What is the process of the internal audit? How the internal audit is carrying out their activity? What is the plan of this internal audit department? What are the observations of the internal auditor? And have we factored those in while finalizing our report or while finalizing the financial statement? If any of these observations have an impact on the financial statement, this has to be factored. So it's not that it is something new, which we already were doing it under the standard auditing. Now there is a specific clause which has been introduced in the CARO 2020, which an auditor need to report upon. Going concern, the only difference between this procedure, what we were doing earlier, is now, whenever we used to look at the internal audit reports, internal audit department, how they are functioning, etc., we were never required to report upon, because as I said, the audit report which we normally sign off as per SS 700, 705, 706, it typically a format driven report. If you look at one of the listed company report and one of the private limited company report, other than if there is no qualification, no emphasis of matter, it looks one and the same. The clause on the internal audit and various clauses which have been introduced under the CARO 2020 or under the earlier clauses of CARO 2016 also requires you to report upon, requires you to comment upon, whether you report on the facts or you report on the opinion. So even the going concern also, as per SA 570, this was always a requirement which auditors were always doing it. However, now it has been brought in a structured format in the CARO 2020 that you also comment upon looking at the various ratios which have been disclosed by the entity. So these are the some clauses wherein the auditors were already working upon doing this in a procedure or verifying these areas. Now we are required to report upon also. And obviously there are certain modified clauses. We will look at it. What are those modifications? And there are certain retained clauses. So this is the whole gambit of 21 clauses, 7 newly added, 7 modified, and 7 retained. That is how we are reaching to the number of 21. We will discuss the more critical clauses going ahead. And as I always believe, my friends, that this whole change in CARO 2020, if you objectively look at it, they are designed to address these issues basically. One, and you can easily, put the various clauses under these 4 buckets. Diversion of fund. If you look at various clauses which are there on the loan part, whether you have given the loan, whether you have taken the loan, whether the loan has been utilized as per the sanction term, whether you have diverted the fund of a short-term nature to the long-term purposes, or you have not utilized the fund for which it was taken, everything is trying to address one core issue, which is a diversion of fund. So this is one area which a ministry or the regulator is trying to capture through introduction of all these clauses. And they are telling us that you please look at it and comment upon. The other important area which I feel the ministry is trying to address by introduction of these various clauses or modification of these clauses is on this early signal on the financial health of the company. Typically, if you look at it, the going concern clause which is there, the disclosure of various ratios which are there, and the reason for a deviation in the percentage of ratios as compared to the previous period, and the auditor to comment upon that looking at these ratios, whether the company will be able to meet its liability for the next 12 months is typically to address the early signals on the financial health of the company. Is there any early indication that the financials or the company may go for a, like for example, may not be able to satisfy its liability? The other issue which I think all these changes is trying to address is the corporate governance culture at top. Like for example, look at the reporting on the CSR, look at the reporting which is on the undisclosed income, look at the reporting on the Benami property, and you can have multiple clauses which typically are talking about how is the corporate governance culture in the company. So these are the clauses which are crucially addressing or crucially included to comment upon the corporate governance. And the last point which I feel that the clauses have been introduced to deal with is security and the ownership of the asset. be it the clause which this clause was already there. It has been, supported by making an additional disclosure in the Schedule 3 on title deed of an immovable property, or including the reporting on intangible assets, or in revaluation clauses, etc., etc. So these are set of the clauses where there have been modification in the recent time in CARO 2020 are trying to address a situation of a security and ownership of the asset. So one can look at it, and and that is why, as an auditor, for me also, it is not only important to know that what changes have been done in CARO 2020. It is also important to understand, and good to understand, that what is the rationale for these changes, so that we can get a little perspective that how, as an auditor, I need to look at this clause, and how, as an auditor, I need to report this clause. That with the introduction of this clause, what could be the intention of the regulator to address a particular situation. If you have that objective in the mind, I think the reporting becomes very easy for all of us. Now, if you look at typically what is the change, so we know CARO 2020 got introduced in the last year, and there are various changes which have been implemented. I have just tried to put out some of the important changes or impact of these changes on the audit area or on the reporting area. Now, if you look at typically, my friends, as an auditor, I always used to give an opinion only on the financial statement. And in CARO 2003 or in CARO 2016, typically we believe that CARO 2020 or CARO 2016 or CARO 2003 is nothing but a statement of fact. And I'm just reporting a fact on those cases, or I'm just giving information to the ministry by way of including certain information, like, for example, disputed dues, default in repayment of a debt obligation by the company, so on and so forth. There were very limited clauses, and there were very, very few clauses where we were giving opinion, or where we were asked to give the opinion. Now, in the current CARO, if you look at it, and it is very important for us to bifurcate that on which clauses an auditor or we are commenting or giving a statement of fact, and on which clauses I'm giving an opinion. Because if I'm giving an opinion, I need to be more careful about it. So one important fact which I could look at it in CARO 2020, that there is an increased number of clauses with matters of opinion than the matter of fact. Like, for example, I have put the number 27 plus 13 plus 7. If you total it up, it becomes 47. There are 27 clauses where we are reporting sub-clauses. Basically, we are just reporting the facts, basically whether the stat due has been paid on time, whether there is any disputed due, so on and so forth. I'm reporting on all this on 27 clauses. On 13 clauses, partially I'm giving statement of fact, and partially I'm giving the matter of opinion. Like, for example, if you look at it, the undisclosed income clause. The undisclosed income clause, if you need to bifurcate between the two, it very clearly says that whether there is any undisclosed income, and whether the company has appropriately recorded it. Whether there exists an undisclosed income is a matter of fact. Now, whether it has been appropriately recorded in the books of accounts is a matter of opinion, where I need to comment upon whether they have been appropriately recorded or no. That is not a statement of fact. So there are certain clauses in all 13 clauses wherein the auditor has to partially report on statement of fact and partially report on a matter of opinion. There are 7 clauses on which we have to just give the opinion. We will look at those clauses. We have to just give the opinion on those clauses. Like, for example, the internal audit clause, if you can look at it. We just have to, in one of the clauses of the internal audit, we just have to say that whether they are commensurate with the size and nature of the company. Size and nature and the business of the company, and whether they have been, they are within the scope, or their scope is proper or not proper, if I look at the guidance note. So the one point which I'm trying to highlight over here for all of you to understand is that whenever you are commenting upon any clause, please look at this clause, whether this is an opinion or this is a fact reporting. If it's an opinion, we need to be made more careful. But if it's a fact reporting, it is just a statement of fact, what we are reporting, what has happened in the company. The second bullet, which exactly highlights that as of today, we are giving two kinds of an opinion. One, we are giving opinion on the financial statement. Another, we are giving opinion on certain specific item. Like for example, I have called it out in the slide, internal audit, loans, which are prejudicial to the interest of the company. There I'm giving an opinion. It's not a statement of fact. Going concern is an opinion, not a statement of fact. So one has to be very careful when they are giving a statement of fact and an opinion on in the CARO 2020. One important point which I can understand, and when I was doing the reporting in the last year, that there are some clauses where you have to be very careful to ensure that there is a consistency between the main report and the CARO reporting, because there are some overlapping clauses also, or there are some overlapping issues also which are there. Like I have highlighted two issues, and we will look at those issues as we move ahead in the presentation. The going concern issue and the loan issue, basically. We will look at it how one has to be consistent between the main report and in the CARO annexure which we are giving. Interconnected clauses, and this is one of the unique feature of CARO 2020, which actually I have tried to understood. That if you are giving a negative remark in one particular clause, there could be some impact on the other clauses also. Like for example, let's suppose you are reporting that there are companies, or your company which you are auditing in the current year has disclosed certain undisclosed income, surrender certain undisclosed income. Now this could have an implication on your fraud reporting also, because when you say that the company during the year has surrendered certain undisclosed income, now this could not be an error. There could be an intentional hiding of the things also. Now whether this could lead to reporting under the fraud clause, or let's suppose you have a short-term funds which has been utilized for long-term purposes. Now this could have an impact on my going concern clause also, because what the going concern clause is saying that next 1 year, whatever liability is about to due, whether you have a sufficient to pay off or no. Now, if you have a negative observation on short-term versus long-term fund utilization, this could have an impact on your going concern clause also. So what I'm trying to make you understand, or I'm trying to highlight, is that there are certain interconnected clauses also, which one has to be very careful about. If you have reported in a particular manner in one of the clause, we need to look at it, the implication of it in the other clauses also. And we will look at some of those clauses as we move ahead. And another important point which has impacted, or where there is an impact, that some of these inclusion in CARO 2020, you would be aware, is based on a regulatory feedback. Now, when I say regulatory feedback, it could be RBI, it could be SEBI, it could be Ministry of Corporate Affairs, it could be SFIO, it could be NFRA, so on and so forth. Now, obviously, when certain clauses have been included with an intention for the statutory auditor to look at those areas and report on those clauses, there would be review of these reporting in the future. So we have to be very careful that there could be a review of these reporting in the future. At that point of a time, we should be very careful about in the manner and in the way which we are reporting upon these clauses. Implication of the reporting on negative remarks in the future. This is very critical. We will look at it in the respective example. Here, the very simple point which I'm trying to highlight is that if you are putting any negative remarks in CARO clauses, this could have a multiple implication, because all the stakeholders today are going to look at this report very carefully, because as an auditor, independently, in addition to an opinion which is true and fair view of the financial statement, you're also reporting on various financial matter in those 47 clauses, which will give insight to the stakeholder, be it the regulator or be it the bank or the shareholder also. One of the most critical points for an auditor to be aware about is documentation of the reporting. You are reporting on 47 clauses, 47 sub-clauses. Some of these clauses are statement of fact. Some of these clauses may have a corresponding disclosure in the Schedule 3 through which you can get the information. However, there are clauses which does not have any corresponding disclosure in the Schedule 3. So we need to be very careful in the way we are documenting these reporting on the CARO clauses, and more specifically those clauses where there is no corresponding disclosure which is there in the Schedule 3. And I have understood one point looking at various reports which are there in the public domain, that the reporting also reflects the quality of the audit which you have done upon. So as and when we go in the presentation, we will look at it, some of the reporting which has been done by the listed company. And looking at the reporting only itself, you can understand that what the quality of the audit is. And this is because of all the above. How much your main audit report is consistent with your CARO clauses, how much your CARO clauses are interconnected. If you have given negative comment on one clause, how have you addressed on the other clauses? And where there was a requirement of statement of opinion or matter of opinion, have you just written a statement of fact over there? So these all will, give a insight to anybody who is reading the CARO audit report. So this is just some of the changes which I thought will be important for all of you to understand, that it is not only a very simple format of the reporting which we are doing, it has a multiple implications basically. So now moving ahead, we have understood that we are supposed to report under 143.11. We have looked at briefly that what are the changes in the CARO 2020. We have also looked at it that what is the impact of these changes in the reporting parameter, whether it is consistency, interconnectivity between the two clauses, so on and so forth. Now in the applicability clause, frankly speaking, there is no change absolutely. I mean, if you look at the order, there is no change. However, if I go ahead, there is one change which I would like to discuss upon. This will be the second change during my presentation, which I'm discussing. So if I have to divide the applicability clause into two simple ways, there are certain companies which are completely exempt from the CARO without any restriction. That means they don't have to satisfy certain conditions. They are completely exempt. If you're a banking company, you are exempt. If you're an insurance company, you are exempt. Section 8 company exempt. OPC exempt. Small company exempt. Here, there is no requirement to report upon under section 143.11 because they are out of the scope of CARO 2020 only. And as you are aware about it, all private limited company have to satisfy certain conditions, and they have to satisfy 4 conditions to get out of the CARO. If they are not satisfying any one of the conditions, they are required to the auditor is supposed to comment upon the CARO clauses. Now, these conditions are cumulative condition. As we have said, all these conditions need to be complied together so as to get out of the CARO. And there is no change in the limits of any of these conditions from the previous year to the current year. One change which I would like to highlight to all of you, and I would request each one of you to pay attention on this change. This is the second change I'm talking about after the change in the audit trail reporting, which we discussed at the start of our presentation only. The other change is a small company definition. And this is a very, very, very important change because frankly speaking, it came in the middle of the year. And, it came somewhere in the month of September. What is the change? All of you are aware about the definition of a private small company. There are 2 limits which have been put it. It's a paid up share capital limit. It's a turnover limit. There is no borrowing limit condition on the small company. It very clearly says that if you have a paid up share capital below a certain threshold, and if you have a turnover below certain threshold, you are classified as a small company. There are various relaxation and exemptions which are available. One of them is CARO 2020 also. So if you're auditing a small company, you don't need to give a separate report on CARO 2020. Now, what is the change over here? Before I move to the change, please look at 2 very important points which have been circled on the PPT. In small company, I need to look at it turnover of the company. And I need to look at it turnover in immediately preceding financial year. Now, very simple, you will raise a point that, okay, what is so big to harp upon it? The important point over here to distinguish between a normal private limited company is that when I go to CARO for a normal private limited company, I look at it total revenue. Now, total revenue obviously includes revenue from operation plus other income. And this revenue or the most of the conditions is either on the balance sheet date of the current year or during the year conditions, or all these limits I have to test based on the transactions or based on the events which has happened during the year. However, in case of a small company, I need to look at it immediately preceding financial year in case of my turnover limit. Now, it is important for you to understand why I'm again and again harping on this point. In current year, what has happened is that small company definition has gone under revision. The limits which were there earlier, the earlier limits were paid up share capital less than 2 crore and turnover less than 20 crore were called as a small company, basically exempt from CARO applicability. That limit on 15 September 2022 has been increased from 2 crore to 4 crore and 20 crore to 40 crore. Basically, I think some ministry follows some rhythm kind of a thing, 220, 440. Now, next could be 660 also, we don't know. So, important point for here to understand is, if your paid up share capital as on the balance sheet date for the current year is less than 4 crore and your turnover not during the year as per the previous financial year or as per the profit and loss statement of the previous immediately preceding financial year is less than 40 crore, you will be exempt under the CARO. You will be exempt under the CARO. You don't need to comment on the CARO in the current year. Now, if your turnover goes beyond 40 crore in the current year, you will comment upon in the next year. Now, let's look at it with the help of example. I think that will make you all very clear that what I'm trying to address over here. This is a ABC private limited company, typically a private limited. Assuming all other conditions are not applicable, they are not a holding in subsidiary of any other company, etc. The paid up share capital is 2 crore. Turnover of the company in the current year is 45 crore. In the previous year, it was 25 crore. During the year, the company has taken a term loan of 5 crore and the same is outstanding as on 31st March 2023. Now, we need to evaluate the applicability of CARO 2020 because this is one point, my friend, which I understand that sometimes people misjudge and miscalculate. That when the CARO is applicable to me. Now, if I look at the applicability clause, I have to first look at it whether I'm a small company or not, because I'm not a banking company, I'm not an insurance company, I'm not Section 8 company, I'm not OPC, I'm purely a private limited company. So the only way I can go is the small company definition, the immediate next reach I can do. So when I evaluate the small company definition, if you look at it in this clause, the paid up share capital is less than 4 crore. Why? Because it is 2 crore, which is obviously less than 4 crore. And turnover of previous year. Now you'll ask me, Pankaj, why are you looking at turnover of previous year? Because that's what the definition of small company tells me to look at it. It says turnover as per profit and loss of the immediately preceding financial year. So if I look at the turnover of immediately preceding financial year, it was around 25 crore, which is absolutely less than 40 crore. But if I look at the turnover of the current year, it is 45 crore, which is higher than the turnover of the, obviously turnover as per the limit, which is 40 crore. But all these, both the condition during the current year has been satisfied. My paid up share capital is less than 2 crore, less than 4 crore, which is 2 crore. And my turnover of previous year is 25 crore, which is less than 40 crore. And hence I will be covered under the definition of a small company. And my auditor of my company is not required to report on CARO clauses. All 47 clauses I get out of it. Very important point to highlight it. So whenever you are evaluating, now if you look at this as a private limited company, if I ignore the small company definition, all the conditions are satisfied. That means whether I'm less than 1 crore, negative. All the conditions are not satisfied basically. Whether the paid up share capital plus reserve is less than 1 crore, no, because my paid up share capital is 2 crore. I have a borrowing which is 5 crore. I have a revenue from operation which is 45 crore. So if I look at the private limited company definition or the private limited company criteria, I am not exempt, but I am a small company and hence I will be exempt from the reporting under the CARO. Now, somebody can argue that, okay, Pankaj, if you say this way, then what is the use of this private company definition? Frankly speaking, these limits need to be revised. What has happened that over a period, the small company definition have got changed. It started somewhere in the lakhs and now it is running into crores. However, the private limited company exemption criteria are still very old and ministry seriously need to look at these criteria. Otherwise, they will become very redundant criteria for a company which is complying with all other condition of a subsidiary and the holding company. So the takeaway from this whole discussion and change in the small company definition is that if your company falls into the definition of a small company, even though you don't satisfy the conditions which are given for a private limited company, you will be exempt from CARO. And your auditor is not required to comment upon the CARO 2020 clause. And you can also look at this guidance, which is given in para number 12 of guidance note 2020, very clearly highlighting the exact issue what we are discussing about. That if you look at the highlighted portion, it may be also noted that in case a company is covered under the definition of a small company, it will remain exempted from the applicability of the order, even it falls under any of the criteria specified for private company. That is what exactly we were discussing upon. So I hope all of you have understood that what was the point of discussion on this paragraph, or what was the importance of this circular. So as I say, this is the ease of reporting which has been done by the government of India, in addition to ease of doing business. So they increased the small company definition to get various kind of exemption. One of the exemption which has been given to the auditor is also that you are required to report only on the financial statement and not under CARO 2020. These are the two very beautiful publications which are issued by the institute, and one must look at both the publication. One is on this guidance note CARO 2020, which has been given to all of which is available in the public domain, which I think Sanjeev sir mentioned also at the beginning. Very beautiful guidance note, which practical insight. Another important publication which I would like for all of you to look at is Significant Audit Matter, which is issued by Center for Audit Quality in the last year. It got introduced somewhere in the January or February of 2023. This publication basically gives you a whole illustrative list, or I will not say illustrative. This compilation includes compilation of CAM, EOM, qualification, disclaimer of opinion, and reporting on various clauses of CARO, a unique reporting done in case of 450 listed companies. So what has been done is that 450 listed companies have been compiled together, and unique points which are there in each of those CARO clauses have been picked up and have been compiled in this publication. And to be very frank, since last 3 months when we are closing listed company audits, I have been using this publication quite often, because lot many qualifications or lot many reportings which we need to do in the current year or in the current on the companies which we are auditing, you can get a ready guidance available that how the others have reported it. You can look at that. You can look at how the market practice is to report on certain clauses, or what is the industry practice, how various auditors have reported on those clauses. So this is a ready guidance which is available on the institute platform. You can go and download it and can use it also. It's a very helpful. Let's suppose you have to comment on certain clauses in negative way. So this publication includes certain clauses which have been reported in a negative way also, and you can take the help of those clauses and comment upon. So my sincere request to all of you, please look at these two publications. They are very, very, very unique and very important publication, very insightful. Now, this is what we just discussed about various aspects of the CARO. What are the changes in the applicability clause, definition of a small company, audit trail, what is this statement of fact where we need to report matters of opinion, what are the important points for which an auditor need to be careful, how the CARO 2020 has impacted our reporting parameters. Now, the second part of my presentation, which will take a little time for us to discuss, is analysis of the critical clauses in CARO 2020. And this is the most important part of my session, which is where we are going to analyze important clauses which are there in the CARO 2020, more specifically where there is no corresponding disclosure in Schedule 3. Because as you are aware, not all clauses have a corresponding disclosure in Schedule 3. And similar way, not all disclosure have a corresponding clause in the CARO 2020 also. There are certain gaps which are there. And for ease of understanding what I have done in my subsequent slide, wherever you see this red dot, you can understand that there is no corresponding disclosure in Schedule 3. And why it's red? Because we have to be more careful. As I discussed in the initial slide of my presentation, the documentation of reporting on these clauses become very crucial, because management does not have to report upon it. But as an auditor, I need to comment upon it. So that will be in the red, and wherever there is a corresponding disclosure in the Schedule 3, that will be in the green, that at least we have some information from the company or somewhere that information has been disclosed. Let's look at it. What are the clauses? And as and when I move ahead, my friends, I will also show you some of the errors in the reporting which has been done in various companies, which one at least we should be careful about, because it is better to learn from the mistake of others rather than doing the same mistake by ourselves. So please pay little attention specifically on the clauses where people have reported in an inconsistent way. Now, and as I said, I will not be dealing with all the clauses. There are some selected clauses which I'll be dealing about. The first and most important clause, which is on the intangible assets, and this got introduced in last year, which has no corresponding disclosure in Schedule 3, obviously because it talks about maintenance of proper records. Now, for maintaining proper records, there is a provision in the Companies Act which directs the company to maintain our books of accounts, etc. Now, what is the meaning of, when this clause came, there were 2 to 3 points which were discussed in a great detail. One of them, what do you mean by proper records? How should I maintain proper records of an intangible asset? Like, for example, I might have hundreds of laptops or 200 of laptops. Now, each of these laptops might have certain licenses. Do I need to maintain separate register for these licenses, that which license has been deployed in which laptop or has been included in which computer, etc., etc. If you need to look at it, what is the meaning of proper record? The proper record definition is already given in context of my property, plant and equipment. So one should look at that definition, which exactly says that you have to maintain the location of these intangible asset and the description of it. Amortization schedule of an intangible asset is not a proper record, because many of the companies in the previous year have submitted to us the amortization schedule, which has a whole list of intangible asset, mainly the licenses and the software, and you are depreciating it. The same has been handed over to us, saying that this is the record of an intangible asset. That is not a proper record. Proper record should obviously include the location at a minimum. And obviously one can draw guidance from the property, plant and equipment, information which is given in the CARO 2020 guidance note, and can also implement it for intangible asset. Now, another important point which came up. So this was regarding how do I maintain if there are n number or there are multiple intangible asset or there are many intangible asset or small in nature. Another was that self-generated or developed intangible asset. Many of the fintech companies in India develop certain technology platform by themselves. By some of the promoter will come together and they will develop a platform. Now you would have incurred expenses over a period, right? Over a period you would have incurred these expenditure which you would have shown as an intangible asset under development. And now in the current year or in the previous year or 2 years back, you would have capitalized it. Now for this, what should I have? What will you call it as a proper record for this intangible asset? There are many debates which is around it, that what should I have, all the information or all the costs which have been capitalized over a period, or should I have just one simple line saying that this is the intangible asset which has been capitalized during the year and this is the total cost which has been incurred. Now over a period, you have shown this intangible asset under development. In the year in which you have capitalized it, that will be the year in which you will start maintaining proper record for it. That means that will be the year in which it will come in the intangible asset register and go ahead. So you need to maintain the detail of these intangible asset once it has been capitalized, because once it is, it is under the development phase, you might have capitalized certain expenditure, but if it is not successful, you might write it off also in the P&L account. Once you have completed your development and it has been put to use or it is ready or available for use, that is the time when you will start looking at the proper records for this intangible asset. And simple will be that at which location this intangible or this technology platform is available, where it has been kept, and from the day when I've started using these intangible assets. That is what a simple, one has to look at it when they are looking at this self-generated or developed intangible asset. Another important point is that if there are certain old intangible assets, and this is typically in the organizations which are not a listed organization, because in listed organization, you will have a SAP detail, and everything will be available at your disposal to comment upon this clause. Now, there are certain companies or there are small companies where there are certain old intangible assets for which we don't have the details, or the company is not in position to provide us the ready details for this. If there are no details, my friend, my sincere request to all of you is that please mention that in the audit report and move ahead, because this is less harm clauses basically. These are less harm clauses. If the details are not available and if the company is in process of preparation, we can include a suitable note saying that the company is in process of preparation of these proper records of these intangible assets. And if there are no details are available, you can simply say that we are unable to comment upon since there is no details of intangible assets are available with us. This clause is typically a fact reporting clause, because if you look at it, very simple, whether the company is maintaining proper record. Now, one could say that it includes certain, judgment, because what do you call it as a proper record, which is not defined under the Companies Act. However, what you need to report upon is that whether they are maintaining proper record, and proper record, you can draw the reference from the property, plant and equipment, the information which has been given in the CARO 2020. An important point for all of you to be aware about is that look at this reporting and very simple, and this is a very silly mistakes what people do in certain reports. And this is a listed company balance sheet which has been picked up and put it to all of you. And this is for our information and our knowledge. Look at the asset side of the balance sheet. The asset side of the balance sheet includes property, plant and equipment, capital, work in progress, and other intangible assets. Now, clause 1A, if I look at it, typically says that the company has maintained proper records showing full particulars, including quantitative details and situation of property, plant and equipment. Now, if you look at the clause is very clear that first, whether we have maintained the proper records for property, plant and equipment, and second, we have to comment upon the intangible asset also. Now, what has happened in this clause or by the auditor in this reporting on this company is that the auditor has missed out from the reporting on the intangible asset, irrespective of the materiality of that amount. Irrespective of the materiality of that amount, a clause there has to be a specific reporting on the intangible asset. So let's be very careful that, if there are intangible asset in my books of accounts, I need to comment on this clause. It cannot be, a miss from my reporting. I need to comment on both property, plant and equipment as well as on the intangible asset. So this is one, example which I thought it will, I will bring it to your notice so that it can be, captured in your reporting. Now, another clause, and this is, I think, a very fairly simple clause, which is title deed of a immovable property. Now, this clause was already there. I mean, there is no new introduction on this clause, or there is no modification under this clause also. This clause was always there. There is reason for not being in the name of the company, also indicate whether there is any dispute going on, so on and so forth. So what is the requirement of this clause? That if you have an immovable property, whether the immovable property is held in the name of the company or no. Now, there is one debate which was there that what do you mean by immovable property? I think the guidance note settled that issue. And they said immovable property means your property, plant and equipment, your investment property also, which you would have taken it and you have given it on a rent for capital appreciation. And it also includes asset held for sale. That means which you have carved out from your property, plant and equipment, and you have shown as an asset held for sale because you're going to dispose of in near future. Now, all this should be included property, plant and immovable property. And when you are commenting upon, you need to see that whether the title deed for each of these is available with you or no. So one debate is settled that what do you mean by immovable property? Another issue is that reason for not being held in the name of the company to be ascertained and disclosed. Now, fortunate part after CARO 2020 plus Schedule 3 amendment is that even the company are now required to give this kind of a disclosure. That means in Schedule 3, they will also disclose that whether there is any immovable property which is not held in the name of the company, and the reason for it, the reason could be that the name has not been shifted because it has been acquired as a part of an amalgamation or a merger, and the name change has still not happened, or they are in process of happening, or there could be multiple reasons for it. This is nothing but a statement of fact. This is nothing but a statement of fact that whether this immovable property which is held in the name of the company has been whether they are held in the name of the company or no. If no, reason for this, and whether there is any dispute going on this property. That is what we need to comment upon it. We don't have to get into the giving an explanation for claiming a depreciation and why still we feel that the company is the owner of these assets, so on and so forth. So our job is very fairly simple. Our job is that we just have to give a disclosure or give our comment that if we have any immovable property, whether it is held in the name of the company. And our job becomes very easy now because the corresponding disclosure is also there in the Schedule 3. Now, one important point for which you all should pay attention is that if you have to decide your title deed or if you have to decide the ownership of the asset, there are multiple documents, and we are not the lawyers to identify that whether there's a, whether the company is the rightful ownership or owner of this asset or no. We will look at the title deed. We will look at the legal documents which are available. And prima facie, if we feel that there is an evidence to show that the company has a legal ownership of the asset, I will comment upon it. By commenting on this, I am not giving a confirmation that in a legal framework that the company is the rightful owner of these assets. Whatever documents are available with me, basis on which I'm just saying that the property which are there in the balance sheet of the company is the company has the title deed of these immovable property. That's it. There could be multiple dispute relating to it in the near future, and somebody cannot hold us accountable that, oh, you looked at these documents and you reported upon it. So what, as an auditor, we should be careful is that we should be very careful in limiting our reporting only to the statement of fact rather than giving any opinion on this part. Another important point which one should be careful about and one should look at is that many times what happens is that the property which are mortgaged with the banks. Let's suppose I have a property which is sitting in my balance sheet as an immovable property in property, plant and equipment. However, the original documents of this property may be with the bank. As part of your confirmation process or as part of your process to give a comment on this clause, because this is nothing but a statement of fact, we can't rely on the Xerox copies. We can't rely on the photocopies of the title deeds which will be submitted by the company, because as you know, we are living in this kind of a world where documents can be created also. So unless and until either you get a confirmation from the bank that yes, these title deeds are in the name of the company, or we get the original copy of the documents, we look at the original copy of the document, we need to state very clearly that what we have verified. If we have not been able to verify these documents, we should clearly write it in our reporting that we have not been able to verify and hence we are unable to comment upon. So if you look at this clause, and this is one of the reporting done by one of the company, one of the auditor in one of the company, which was like, in respect of immovable property, pledged as a security for borrowing. So they had an immovable property which was pledged as a security for borrowing. The company is in process of obtaining confirmation of title deed deposited with lender. That means the company was obtaining a confirmation. As an auditor, you can also ask for a confirmation from the banks. However, here the company has gone to the banks and asking for a confirmation on the title deed of the title deeds which are deposited with the lenders. And accordingly, we are unable to express our comment on those items of the immovable property. So you could have multiple property. On some property, you have verified the title deed and you are sure that they are held in the name of the company. On other property, there could be that these title deeds are not with the company, are with the bank, on which you can rely on the confirmation and can comment upon. And if you have not got the confirmation, you can just clearly say that we are unable to comment upon. It is very important for us to put such kind of a reporting or such kind of a disclaimer in our reporting on the CARO clauses, because you're giving a statement of fact. If you have not seen, you have not seen. Another important point which is there is on the revaluation of a immovable property. Revaluation of property, plant and equipment and intangible asset. Very, very, very important and high chances of doing a silly error in these clauses. And as I said in the beginning also, my friend, the quality of the reporting in the CARO shows the quality of your audit. And it also shows the quality of diligence or the due diligence you have applied in while carrying out the audit. Revaluation of property, all of you are aware, we can do revaluation of each class of the property, plant and equipment. The class has already been defined. And both AS10 and Ind AS 16, because this is a common CARO report. This is a common CARO order for Ind AS company and as well as IGAP company. And this is one unique subtle difference where one has to be careful whether their company is under Ind AS or whether their company is under IGAP. Property, plant and equipment, there is no issue because both AS10 and Ind AS 16 allows you to follow a revaluation model. But my friend, when it comes to intangible asset, AS26 only allows cost model. AS26 does not allow a revaluation model. However, Ind AS 38, the corresponding Ind AS for intangible asset, allows cost and revaluation model both. So when you are an auditor of a company which is following IGAP, many of our unlisted company today who have not crossed the net criteria for implementing Ind AS are following IGAP. Now, in those cases, AS26 is applicable. And in those cases, this revaluation of intangible asset clause may not be applicable. It is applicable only in those cases where you are applying Ind AS 38 or where your company is under Ind AS 38. So one has to be very careful that when you are writing on this clause or when you are responding on this clause, whether you are responding on a company which is under Ind AS, then you don't have to worry about, both can be revalued and they have not been revalued. In the cases where you are following under AS26, revaluation of intangible asset may not be possible. And another important point which people keep on debating and which is one area where there are difference of opinion is that in which year I should report upon. Let's suppose I have carried out a revaluation in the previous year. Do I need to again comment upon in the current year? Answer is simply no. If there are no revaluation in the current year or there is a revaluation in the previous year, you don't need to comment upon. This is year by year reporting. So no revaluation, no reporting to be done. Revaluation was done in the previous year. We have done the reporting in the previous year. If you look at this clause is divided into two parts. One is that whether you have done a revaluation based on a report which is obtained from a registered valuer and whether this change is more than 10% of the net carrying value. These are two different reporting which an auditor has to do in their report. One, we discussed that if there is a change where the revaluation is possible and when an auditor need to report upon, only if the revaluation done in current year and if there is a change of more than 10% of the net carrying value. Now, there is another reporting which an auditor is expected to report, that whether these revaluation which have been done, whether these reports were obtained from a registered valuer or no. Now, in these cases, if the reports have been obtained from the registered valuer, well and good, no issue for your company, you can just report upon. But if this revaluation report is not received from the registered value, what should I do? As an auditor, what is my responsibility? As an auditor, what should I comment upon? Should I give negative remark or how the reporting should happen? Here, there is no guidance, there is no clarity in the guidance note of the CARO, but there is some guidance which is available in the Schedule 3. So very important for you to understand that what if my company has done a revaluation and they have not obtained the valuation report from a registered valuer. Let's see how we deal with that situation. Another important point is that you should be consistent in disclosure in Schedule 3 vis-a-vis disclosure in the CARO report. And look at this example, my friend. This is again a second error which has been observed in the, when I was reviewing one of the company. Look at this Schedule 3 reporting. Schedule 3 reporting very clearly says that during the year, the company has appointed an independent valuer for a valuation of property, plant and equipment as per the specified rule. On the basis of the opinion, they have done a revaluation of these assets. Now, if I look at my subclause D in the CARO 2020 reporting, the auditor is saying that according to the information explanation given to us on the basis of examination record, the company not revalued its property, plant and equipment. So obviously there is an inconsistency between the two. One has to be very careful, which I said in the beginning also, that you have to be consistent between the disclosure in the Schedule 3 vis-a-vis in the audit report. This is an example of the error which I was talking about in the company which was under IGAP. Basically, this company is under IGAP, Now, if you look at the reporting on clause D, very simply what they have written, the company has not revalued its property, plant and equipment or intangible asset or both during the year. Accordingly, reporting under 3(1)D of the order is not applicable. This is not correct because the intangible asset cannot be revalued because the company is under IGAAP. And therefore, this intangible asset wording should be removed from this, whenever you are reporting on this CARO 2020. So please be very careful with these situations which are there, where one need to look at it, whether it is applicable to me or not applicable to me. And you can go back and look at many of your reports also. Unintentionally, the same thing would have been done in your reports as well. Now, coming to the one point which I was mentioning in the beginning, that what if the company has not used the registered value report? There could be some entities which would not have used registered value report. As an auditor, what should I do? To be very frank with you, there is as I said in the beginning, when I started this clause, there is a corresponding reporting which is available in the Schedule 3. So guidance note on Schedule 3 says that in case the company has not used the registered valuer for such fair valuation, the fact need to be disclosed. You just disclose the fact that you have not used the registered value report. As an auditor, if I look at my guidance note, it says that the auditor should review the disclosure before making comment in this clause. So what as an auditor I will do? I will look at it. If the company has disclosed saying that they have not used the registered valuer report, I will also simply say that the company has not used the registered valuer report, and just I will stop it over there. I will not get into, one should not get into getting the revised valuation report or giving a qualified remark kind of a thing. We just have to say that the company has not used the registered value report. That's it, my friend. Please be very careful with these small issues which are there, because all these clauses, there could be some potential errors which might happen in the report. Benami property, to be very frank, I haven't find, I couldn't see any reporting done by any 450 listed company which we analyze for the purpose of the compilation. However, and there is a corresponding reporting which is available in the Schedule 3 which the company also need to do, because as an auditor, how can I come to know that whether there is any Benami transaction which is there in the company and any inquiry has been initiated? So more or less, you have a corresponding disclosure in the Schedule 3 which you can take as a base to give a comment in the CARO 2020. One of the important point and a different point which I would like to highlight with respect to the Benami property is that if there is a Benami property or there is a litigation which is going against the company under the Benami Property Act or under the Benami Transaction Act, one need to be very careful that when I'm reporting under Rule 11 in my main report, where I have to give the impact of pending litigations as part of one of the sub clauses of Rule 11, this need to be factored in. Because many a times what we have observed that, okay, you have reported, and that is when, my friend, when I say that the reporting in the CARO clause also need to be linked to my main reporting in the main audit report also. So if you look at it, if you have disclosed a Benami transaction, a case which is going against the company under the Benami Transaction Act, fine, you have disclosed in the CARO. But whether there is a corresponding evaluation which has been done for reporting under Rule 11 also, and whether that has been factored in or not. So one should be careful about it, because what will happen, this will not come within the contingent liability, because there will be a separate disclosure which will be there. Whenever I'm reporting under Rule 11E, normally we refer to the contingent liability disclosure to give the impact. However, one has to be very careful in evaluating this case also while reporting under Rule 11. So that is one point which I thought I will highlight to you all, and you can consider while doing while preparing the report of your entity. One of the issue is that, let's suppose the proceeding are initiated post balance sheet date but before the audit report date. In my view, this should be included because it says initiated or pending. It is not during the year, it is as on the date of the report it has started. So I will, in a way, I will include it in my CARO 2020, and I will ask the management to also include in their financial statement. You all know about the definition of Benami property, Benamidar, and whenever the company is treated as a Benamidar, then only this whole transaction, this whole disclosure comes into play. As I said, there is a corresponding disclosure which is available in Schedule 3, which one need to look at it and accordingly report upon. So under Benami property, what I can tell you from my experience or understanding, that one very important is the Rule 11 disclosure, which I'm giving in the main report, that people tend to miss it. So please look at it also while evaluating it. Another important clause, or a very specific clause added on the basis, I assume on the basis of the RBI recommendation, is this working capital limit basically. So all of you might have reported in the last year that if your sanctioned working capital is more than 5 crore, as an auditor, I need to look at it whether the statement which has been submitted to the bank as part of my monthly, quarterly, so on and so forth, is matching with my financial statement or books of records or no. This is typically done to reduce this kind of fraud which was happening in the past, wherein the inflated data and inflated stock values were given to the banks, whereas books of accounts are showing some other picture only. Important point to note over here are 3 to 4 points, which I'll quickly touch upon. One is that as there is a corresponding disclosure in the Schedule 3 also, which need to be there. The only difference is that there is no limit. So as an auditor, we are on a little bit better side because I need to comment only if the limit is more than 5 crore. And this limit of 5 crore is irrespective of utilization. People who would be aware about little bit banking terminology, this is a sanction limit and not the outstanding. So sanction limit and the outstanding are different. I could have an outstanding of 3 crore, but sanction limit of 5 crore. So the order is very clear in saying that I need to look at the sanction limit of the working capital. Based what I need to, and working capital, I need to look at those working capital which are secured against the current asset. That means typically where I'm submitting some kind of a document of a current asset to the bank to get my eligibility tested, or technically talking in a banking language, to get my drawing power basically. So if these working capital limits, or there's a clean overdraft which has been given to the company without having any security, etc., I need not comment upon, because there is no no security which has been given of a current asset in nature. So to be very frank with you, this clause was required more from the perspective of bringing a discipline in the company when they are submitting the quarterly returns to the banks for the purpose of their working capital. Another important, so first we discussed that we need to look at the sanction limit irrespective of the outstanding, irrespective whether higher or lower, irrespective of the outstanding. We just need to focus on the sanction limit of the working capital. The second is that there has to be a current asset which should have been given, because a lot of people in the last year were debating, okay, you have a working capital, but that working capital is not supported by any current asset. Do I still need to disclose it? The answer is very clearly no, because there is no security of current asset which has been given, which I need to validate. Because the important point over here was to see the reconciliation between, or to see the figures which have been given to the banks and reported in the books of accounts, and compare and comment upon. Now, if there is no statement which need to be submitted, this clause may not be relevant for those kind of a facility. The third important point which I would like to touch upon is about the NFB facility, basically the non-fund based limits. Now, there could be, typically speaking, there are multiple type of non-fund based facility which are given to an entity. Like, for example, you could have given a LC. You could have, the bank might have issued or might have given a limit to the company to open a LC for import of a machinery. Now, whether this is a working capital, maybe no. But if I have given a bank guarantee or a LC for import of my material, so then it could be a working capital facility. So one need to be very careful. And obviously the sanctioned working capital limit, when I'm determining, it is fund plus non-fund based. But what kind of non-fund based facility my company is availing, one need to look at it before they implement this clause, or before they go ahead on reporting in this clause. So 3 to 4 points, as I said, you have to be very careful that you are looking only the sanction limit. You have to look at it that whether this sanction limit is against any current asset, and what are the NFB facility one need to look at, one need to consider while determining this 5 crore limit. Whether all NFB facility need to be looked at it, which are capital in nature also, or I only need to look at it the working capital, the NFB facility which are sanctioned in the nature of a working capital. You need to be very careful, and you can easily look at the sanction letter of those company. You can easily come to know also. This is the way many companies have disclosed in the last year, and all of you might have disclosed also. So you give quarterly wise breakup, that what is the trade receivable, what is the trade payable, what is the inventory as per your books of accounts, and as per your what are the returns which are filed with the bank, and the differences which have been called out. The left side disclosure is by the company, the right side statement is by the auditor. And as an auditor, I just need to comment upon that as disclosed in this note on the basis of security, they are broadly in agreement, or if I have any observation, I need to bring upon. But as I said, 2 to 3 points clearly one should factor upon. Now, this is one more instance which I can call it out, is that let's suppose your company is a NPA, unfortunately, it's a non-performing asset. And when you are a non-performing asset, you need not submit. I mean, you are not required to submit, or you don't submit any quarterly stock statement and book date, etc. to the banks, because frankly speaking, you are not availing any facility. Now you're a defaulter. In that case, how an auditor should report upon? The auditor should report exactly the fact. They should state the company has not filed its quarterly return statement with the bank or financial, as its loan has been categorized as a non-performing asset, and hence we cannot comment on this clause. So these are some of the unique reporting which one can look at it and can comment upon, looking, depending upon the situation in your company. This is another important clause, my friend, which one need to be careful about. The whole clause around the loans and investment done by the company. And I will come on each of these clauses, because there are some subtle changes which have been done during the year, which one need to be very, very careful about. And let me tell you, some of these clauses, sub-clauses of these clause number 3 does not have any corresponding reporting in the Schedule 3 also. First clause is very fairly simple. Only one point which I would like to highlight to all of you over here is that what this clause is asking you to do, or what this clause is expecting you to do. This clause is frankly asking that whether you have given any loan, or you have made any investment, or you have given any guarantee, or you have given any security. If you have given, please disclose whether you have given it to your group companies, which is subsidiary, joint venture and associate, or you have given it to the third party, which is not a subsidiary, joint venture and associate. And this clause is typically not applicable to the companies whose principal business is giving the loan. Obviously, I mean, goes without saying. Otherwise, they have to make a big disclosure if it made applicable to the loan companies. Till now, there is no issue. What it requires you to do is that if you read very specifically the clause A, small a, whether during the year the company has provided loans or provided advance in the nature of a loan. Now, this is a new terminology which has been coined in CARO 2020. Because earlier, if you look at the CARO 2016, which I put down, there was no such term. And that is where some people have missed reporting on this clause. That it is not only a loan I need to report upon, but it is also I need to report upon the advances which are in the nature of a loan. And obviously, it is very difficult to identify such kind of advances that which are in the nature of a loan. So first point of differentiation between clause number 3 earlier versus clause number 3 now, obviously you need to report upon investment, guarantee and security. That is a factual statement. But where is the auditor's judgment is involved is in identifying these advances in the nature of a loan. And as I said, these advances in the nature of a loan is a very subjective criteria. So somebody has to provide us a guidance that what you mean by advance in the nature of a loan, because it is not defined under the Companies Act, or it is not defined anywhere else. If you look at the guidance note on Schedule 3, it has provided some guidance. What it basically says that if you have given an advance to a particular entity, which is far in excess of the value of an order, like for example, you have placed the order for 50 lakh rupees and you have given an advance for 1 crore rupees, they are typically can be called as an advance in the nature of a loan, or for an order, or for a period which is far excess of the period for which the advance are usually extended. Now, if you are placing the same order with some other company, you are giving them advance 3 months before. Now, in this company, you have given advance 1 year before only, before the order. Now that could also be called as an advance in the nature of a loan. So the important point for us to look at it over here is that, okay, if I have given a loan, that will come as a factual reporting that this loan has been given to these parties. But important point for the people to understand is this, that which are quasi loan criteria, quasi loan category loans. Basically, these advances in the nature of a loan is nothing but quasi loan. And this is what typically the government want us to report upon through introduction of this clause. How do I identify? This is the way you should identify. And this is the typical way the people should report upon, whether you have given guarantee, security, loan, or advance in the nature of a loan. Now you'll ask me, Pankaj, okay, this is very good. Whether any company has reported upon it? Yes, my friends, there are many companies which have reported upon it. And one of the disclosures you can see on the right side of your slide, that in this case, the table, if you can look at it, and the line which has been mentioned, according to information explanation given to the company has not provided any loan or stood guarantee or provided security to the company. However, the company has provided trade advances in the nature of loan to other entities during the year. Now, the auditor who has identified this obviously have looked at it, that what is the quantum of the loan advance which I have given and what typically I normally give, or what is the period of the advance I have given and what I have already given it to this particular entity. So the unique reporting or the different reporting which is expected from the auditor to comment on this clause is these advances which are in the nature of a loan. So please look at the advances which are sitting on your asset side of the balance sheet of your company and do the aging analysis of it and look at it whether there is any long pending advances which are there wherein you have not recovered the money from the customer or from the from the supplier whom you have given the advances and they're still outstanding in your balance sheet. Another important point, and this is where I say, and this is typically I would say that you are giving an opinion. So we looked at 3.1 major highlight, advance in the nature of a loan. If you have, please report it. Others are business as usual reporting. Another important in 3B, if you look at it, my friends, this is, and this, I don't call it as a new clause. This clause was already there. This clause has been little bit extended. I'll tell you why. First of all, there is no corresponding disclosure in Schedule 3. That means the auditor is whole and sole need to report upon it. And this is applicable to NBFCs also. So what this clause typically requires you is that if you have given any loan or guarantee or investment or security, whether this transaction is prejudicial to the interest of the company, that this is not in company interest. That means you have done something, the company or the board of directors have done something which is not in the interest of the company. The auditor is required to report upon with respect to these transactions, that you have done certain investment, you have given certain guarantees, you have given certain security, and you have given certain loans which are there, or advance in the nature of a loan. First of all, this is applicable in the year of transaction. Let's be very clear that till when I need to report upon. So this is applicable for the year of transaction. That means in the year in which I made the investment, with the year in which I gave the loans, so on and so forth. And one of the important point for me when we were looking at the reporting in the last year is that this clause need to be evaluated at the time when I gave the loan. You understand? Somebody cannot come to me after 5 years. Let's suppose I gave a loan to one of the subsidiary or one of the entity. At the point when I gave the loan, the company was very much making profit. The company was well rated. The company was having surplus cash flow and repaying my advances also. Now, if the facts and circumstances have changed over a period and later on, maybe XYZ reason, the company is not making profit, you can't today tell me that no, this loan is not prejudicial to the interest of the company. That is not correct. If I'm looking at it, I need to look at it, the facts and circumstances of the loan when I gave the loan and not today. So very, very important point one need to be careful, one should carefully analyze is that the facts and circumstances need to be evaluated at the time of giving the loan. In hindsight or subsequent facts and development cannot be considered for calling a loan as a prejudicial to the interest of the company. If the facts and circumstances were existing at the time of a grant of a loan, then you can report that they are prejudicial to the interest of the company. Otherwise, no. Now, one could ask me that, okay, Pankaj, how do I look at it? That how should I say that whether this is prejudicial to the interest of the company or no? Now, there could be multiple factors which you can look at it. However, basic factor you can look at it. What is the rate of interest you are charging to the client, charging it to that entity? Now, obviously, if you are a holding company and this is another is a subsidiary company. Now you are borrowing at a 12% and you are giving loan at a 7%, etc. Understood, because you are planning to, what you say, bring your company or handhold a subsidiary company. Provided you comply with section 186 of the Companies Act 2013. That means GSEC rate and all you comply. Now, if you borrowed a loan at 12% and you are giving to a third party at 7%, you are making absolutely loss of 5% without any business logic. Without any business logic, that cannot be justified by any other explanation. That can be called as a prejudicial to the interest of the company. So either you have charged lower rate of interest, or you have given a loan without taking any security, or the repayment schedule is favorable to the company to whom you have given the loan, or the financial covenant as such in nature that they are favorable to the other entity. There could be multiple factors which an auditor need to look at it when they are reporting on this clause, and this is a very, very serious clause. Because when you report under this clause, it is looked up by stakeholder very differently. And that is when I say the implication of reporting need to be evaluated before you actually comment upon. And that is why the auditor need to use the financial or commercial acumen to judge this kind of a situation. One important point I want to tell you all that if you are reporting anything under this clause in a negative way, one should be very careful that what are you going to do with section 143 1A reporting, where exactly the same question has been asked, that whether the terms on which the loan have been made are prejudicial to the interest of the company or no. So be very careful. This is another area of a consistency between the CARO reporting and the main reporting. Now, if you are saying here that these loans are prejudicial to the interest of the company, what are you going to call under section 143 1A? Both should be consistent only. And this is what people have reported it in many companies. Like, for example, if you look at the first reporting, they're saying that yes, they have given a loan, but this is prejudicial to the interest of the company as these trade advances are non-interest bearing. That means you have given trade advances in the nature of a loan you have given, and you have not charged any interest on it. So that is prejudicial to the interest of the company. The second example also, which I put on the slide, exactly says the same thing, that they are prejudicial to the interest of the company on account that the fact that these loans are fully provided for in the books and no interest being charged. That means you have given the loan, you have made full provision on the loan also. That means it's clear-cut loss and you have not charged any interest on it also. So one need to be very careful about the loans which you have given, what are the terms of those loans, and any of these loans can be called as a prejudicial to the interest of the company. And another important point you to be aware, how are you going to report under 143 1A? Another important, and this is fairly simple, I think this was there earlier also, but no corresponding reporting which is there, is with regard to the stipulation of repayment schedule. The clause very clearly asks you that whether there is a repayment schedule is there or not there, and whether the receipts are as per the repayment schedule. That means you have prescribed certain repayment schedule, yes or no. If you have prescribed, whether you are getting the recovery as per the repayment schedule. That is simply this clause is asking you to do. So there is two parts. First, whether have you stipulated, and whether you are receiving as per the repayment schedule. Now, 2 points in this which one should be very careful in understanding is that this clause need to report it irrespective of all the loans which are outstanding or were outstanding during the year. So opening balances plus if you have granted during the year. So this is not typically the clause where you just need to comment upon the during the year loan. That is first point. The second point is that there could be certain loans where there is no specific due dates are mentioned. Now, if there is no due dates, there cannot be any repayment also because there are no due dates which have been prescribed. Those kind of cases need to be highlighted in this clause, that there are certain loans on which there has been no there is no stipulation in regard to the repayment schedule. Third important point, my friend, and this is where typically people will miss, and you can go and check your reports also. If you have called out certain loans where there is no stipulation with regards to the payment, you have called out in clause number C, but there is a specific clause F which clearly talks about the loans which are given without repayment schedule. So if you have reported certain loans in clause number 3C, you also need to report upon the clause number 3F as well. So both has to be interconnected. And that is what I was mentioning at the beginning, that some of these clauses are interconnected. So if there is a reporting in clause 3C with regard to certain loans where there is no repayment schedule is prescribed, there has to be reporting in clause 3F also. Otherwise, both will be contradictory to each other. And obviously, you need to highlight the extent of delay, so on and so forth. So very simple, you need to know, you have to report on all the loans. You have to report on repayment schedule and recovery also. And there has to be consistency between schedule 3.3c and 3.3f. This is how I know many entities have reported upon. I mean, I will not get into it. Like, for example, you can look at on the, the disclosure which has been made by JM Financial. Now, in this case, there are certain loans which have been given to one of the entities of the JM Financial, wherein there is no, which is repayable on the demand. And they have not demanded it. And that is why the repayment of loan is not there. Thus, there is no default on the part of the party to whom the money has been lent, because there is no demand which has been made. And this is repayable on demand. So this is the way you can report upon where there is no repayment schedule which has been prescribed. But remember to report the same loans in clause number 3F as well. So to be very frank, this is the clause which one need to be careful about. 3E, you have to be careful about the evergreening of the loans. This is not applicable to the NBFC, but this is applicable to the other than NBFC. The challenge which an auditor would face upon, I can tell you from a practical experience, is that you can only verify to the first level of funding. This clause, people who are aware about, basically talks about that, have you given any loan to repay the loan by the same entity? Now, my friend, you can verify this only up to the first level. You can't go beyond that, right? You can't go beyond that. So one need to be very careful about that. Whenever you are verifying it, you should say that we have verified the loans given to these entities and verified the repayment from these entities only. There could be a round of funding which would have gone within the group and have come back to you ultimately. You may not be able to look at it. And this has been insisted by the RBI governor in yesterday's speech also. This has been highlighted again. And this is how the people have reported also in past or in the last year's report. Then these were the existing overdue, or they are the advance in the nature of a loan. Another clause is that this is 3F, which I was talking about briefly. We have discussed it. I'll tell you very simply what this clause is. Basically, if you have given a loan, because normally what used to have typically in the previous time, auditor used to write that, okay, we have given auditor used to write that the company has given the loan, but there is no repayment schedule which is prescribed, or these loans are repayable on demand, so on and so forth. So now there is a specific clause which has been included in the CARO, and there is a specific reporting which is required in Schedule 3 also with respect to those kind of a loan. And let me tell you, my friend, these disclosures will be minutely reviewed and seen by the regulatory authority across all the ministries. Loans which are without any repayment, whether they are prejudicial to the interest of the company. So as I said, again, the interconnectivity need to be built upon. That if there are repayment schedule which has not been prescribed, whether they are prejudicial to the interest of the company, and whether I need to report under the specific clause which is there. There is a guide. So one of the important point over here one should be aware about is the guidance note on Schedule 3 talks about is that these loans have to be reported on a gross basis and not on a net basis. So even if you have given a loan to a particular promoter or a director or a KMP, and you have made a provision on the loan, the disclosure has to be on a gross basis and not on a net basis. And the CARO reporting will also be done in the similar manner. This is as per the guidance note on Schedule 3. So please remember these situations because they might be there in your company. And this is how people have reported also in the various entities which are there. Now, this is undisclosed income. Very simple. This clause says that whether there are any transactions which are not recorded in the books of account, which has been surrendered or disclosed. Surrender or disclosed means the company has voluntarily admitted to such addition during the income tax proceeding. Now, as an auditor, to be very frank, there are two responsibilities which are there. First, whether there is any such transaction. and whether they have been properly recorded in the books of accounts. First is a statement of fact, and the second is a matter of opinion. Now, proper recording means what? It means whether you have recorded it properly as per in the books of accounts. Now, if I have to look at the proper recording, I need to look at it from the perspective of Schedule 3. I need to look at it from the perspective of accounting standard also, that whether I should call them as a prior period item, whether I should call, if this is an Ind AS, whether I need to open the financials of the previous year and give the effect in the respective, in the first opening balance sheet of the entity which is available, or how should I look at it if there are any undisclosed income which has been surrendered during the year. So one need to be very careful about it. If you have such transaction, all these factors need to be evaluated. Another is that, have you modified your audit procedure? Let's suppose there is an undisclosed income which has come in the, like for example, certain sales were not recorded in the books of account. Now, have you devised your audit process in such a manner that you can address that risk of a misstatement? That need to be looked at it. And as I said, again, an interconnected clause on fraud reporting. Now, if the promoter or the company has disclosed certain income as a concealed income during this income tax proceeding, do I still need to go and report as a fraud by the company under my CARO clause? So one need to evaluate that clause as well. Willful defaulter, I mean, no major issue in this. One or two points I would like to highlight over here is that if willful defaulter, how should I know? How an auditor will come to know that the company has been classified as a willful defaulter? There are one or two ways. One, you can look at the minutes of the meeting if it is available. Second, whenever you are sending the bank confirmation to the bank, from where they have done the borrowing, you can ask them. But one important point you should remember is that the account should be first defaulter. Then it can become a willful defaulter. Now, if your company is repaying the loan regularly, there are hardly or there are remote chances that your company can be called as a willful defaulter. So this becomes important in the cases where in the companies which are NPA companies. So if your company is regularly repaying the dues and has not received any notices, so on and so forth, this clause will be like a factual reporting clause. The company has not been declared based on the information provided by the management. However, if your company is an NPA and you have a doubt that this could have been classified as a willful defaulter, you can send the confirmation to the bank asking them whether you have classified this entity as a willful defaulter. The second is that you can also look at the respective website of the banks, because sometimes these banks also put out the list of these willful defaulter on their website. You can look at the list whether your company is appearing over there. One important point is that, and where sometimes company and the auditor have a difference of opinion, is that the show cause notice which is received from the bank for calling yourself as a willful defaulter cannot be considered or concluded to be stated in this CARO clause. Show cause notice is nothing but that we are giving you a notice that you come and explain that why we should not call you willful defaulter. That's a process before you get declared as a willful defaulter. So if your company has just got a show cause notice but has not been disclosed, considered as a willful defaulter, as an auditor, we may not report upon it. And again, the interconnected clauses, my friend, which one should be careful about, the fraud clause. That means if you have declared as a willful defaulter, that means you have done a diversion of fund and you have done certain fraud. The other is a going concern of the company, that if you have been declared as a willful defaulter, you may not get any new funding and you may need to, you may not get any new funding and your future projects might be under, suspension or something like that. And it might have an impact on your going concern clause also. So it is not only for you to look at this clause in the isolation, but also look at the interconnected clauses. And this is what I was trying to tell you, that like, for example, the Punjab National Bank, you can go and get the list of willful defaulter. They had updated up to 31st March 2022. When you go, you can look at it because the screenshot is, I think, on 9th May. This gets updated regularly by the banks. And whichever banks you have, you can go and look at the willful defaulter list, whether your company is there. This is the alternate procedure you can perform. The first procedure is get the confirmation from the client, from the bank itself. Another is that the loans which have been, so earlier the loan clause which we discussed, they were loan given by the company. Loan given, investment done, guarantee given, security, so on and so forth. Where we were more concerned about how has been they utilized. whether there is an impairment required or no, etc. This clause is basically loan taken clause, that whether the term loans were applied for the purpose for which loans were obtained. This is mainly to, catch hold of the diversion of fund basically. Now here, many times what happens, and this is practically I'm telling you, term loans which are taken, by the way, there is a corresponding disclosure which is required in the Schedule 3. In Schedule 3, it talks about all the loans, all the borrowings which have been done by the company. Auditor has to only report on term loan. So in Schedule 3, they have to report on cash credit, they have to report on everything, general purpose corporate loan also. Here, I just need to report on term loan which has been taken. So I just need to report upon that if the company has taken any term loan, whether they have utilized it for the purpose or no. How can we look at it? First, the prima facie evidence which is available, which is submitted by the company to the bank, is end use certificates. You can look at these end use certificate, you can rely upon these end use certificate, and obviously because money is fungible, you can't trace that which money came and where it went. So what you can look at it, you can look at the end use certificates, or you can analyze their cash flow statement also, that whether the term loan has come and whether it has been applied or no. To give you a very simple example, let's suppose you have a project in hand which is going around, and the project will be currently sitting in the CWIP, capital work in progress. Now you have got certain disbursement of the loan from the bank for this project, and as you are aware, under Schedule 3, we need to give the aging of capital WIP also now. So how much I spend in 1 year, 1 to 3 years, so on and so forth. As an auditor or as a banker also, what they will look at it now is that they will see that how much money has been disbursed from the bank to the company and how much is the addition which has been done to the CWIP. Because now I will have an aging. Earlier, I used to have just one accumulated amount without any bifurcation that how much it has been capitalized, etc. But now I can easily trace out that how much money came from the bank for a particular project and how much I have applied it over here. In situations where you just have an outright buy of a machinery or any equipment, you can simply look at the invoices and you can easily comment upon it. This typically happens in case of a project loan where you have a multiple disbursement and multiple utilization. And let's suppose, if there are companies where temporary funds have come, but they have not been utilized or they have been subsequently utilized, these facts can be called out. That, okay, this much money had come, this much money has been utilized, this much money is pending also from the perspective of utilization, and this has been subsequently utilized. You also need to look at the balance sheet of those entities also to say that whether the term loan which has come, whether actually the money has been deployed or no. So if you frankly ask me from the term loan perspective, I think this was already somewhere there. We were looking at it. However, now it has been enforced in a great detail. One point which has been highlighted over here is the short-term funds utilized on long-term purpose. Now, very important is that it is purpose and not an asset. So one has to be very careful that long-term purposes could mean many things. I could buy a property, plant and equipment. I could do an investment. I could repay my borrowings with a long tenure, with a short-term funds also. That is also for long-term purposes, let me tell you. So you are doing anything for a long-term purpose with a short-term fund will get covered in this clause. And you need to compare that what are the short-term sources which you have taken, or you can look at the comparison of long-term sources versus long-term deployment also. And obviously you need to carefully analyze your balance sheet. More specifically, the cash flow statement, because that is where you come to know that, okay, what is my addition to fixed asset versus how much loan I have taken for the purpose of a long-term project loans and how much short-term loans I have taken. And then one can comment upon whether you have done this kind of a utilization from short-term to long-term. One need to be careful that if the company has a sufficient cash reserve, this clause becomes difficult then, because they may deploy the purpose, they may deploy the funds from their internal accrual also. So one need to be careful when you are reporting on this clause, and more specifically when the company is a profitable making company. The another clause is that whether the company has taken loan for meeting the obligation of its subsidiary. This is the new clause which has got added. The obligation means that you have taken certain loans from somebody and you have given it to subsidiary for repayment of their own loan. Now, it is very easy to say it on a paper, but very difficult to identify and highlight it, unless and until the borrowing has been done with the condition that I will be paying it to my subsidiary for the repayment of this loan. One of the important point is that this has to be done for the during the year and the earlier year utilization. So if you have done the borrowing in the earlier year, but you have utilized in the current year, or if you have done the borrowing in the current year and utilized in the current year, both have to be reported upon. And important point is that if you are doing such kind of an activity where you have taken a loan and given to the subsidiary for repayment of their obligation, again, the interconnected clauses which one need to look at is 39C and 39D, which is mainly on end use of the fund and short-term fund for long-term purposes. I'm telling you, my friend, it is not very easy to just report in one clause and move ahead. It is very important to have this interconnectivity between the two clauses. And obviously the disclosure under AS 18 or Ind AS 24 also need to be verified. Look at this example, and this is unique example which I had observed, and I thought I will share it with you all. Look at the clause E. The clause E very clearly says where the money has taken to, meet the obligation of a subsidiary. Now, if you look at this clause E, the clause E says that the company has raised this much amount through commercial paper, which used to purchase the equity share of the subsidiary company, namely this. Further, the company has also issued NCD, an unsecured redeemable debenture, for the purpose of onward lending to subsidiary. As per the terms of agreement between the company, the proceeds of equity share as well as the loan are utilized to settle the settlement of the subsidiary company. So typically what you have done, you have borrowed through CPs, you have borrowed through NCD, you have taken this loan and given it to the subsidiary. The subsidiary through an investment basically, through purchase of equity share, and the subsidiary has repaid its debt obligation. The surprising part to me was in clause D of the same company, the auditor has commented that no funds raised on short-term basis have been utilized for long-term purposes. Now, I was not very sure that how can this affirmative confirmation could be given. When you look at the balance sheet, I have put the commercial papers duration also. Now, all these commercial paper are maturing within 1 year from the date of financial statement, which is March 23. All these are maturing. Now, what you have done, you have taken a loan. That means you have taken a loan through commercial paper. Basically, these are issued as an instrument, and you have utilized them to purchase an investment in the subsidiary. Now, when you are taking a funding through a CP, which is short-term in nature, and investing in the equity of a subsidiary, which is long-term in nature, on what basis we can say that no funds on short-term basis have been utilized for long-term purposes? So this has been reported by a listed company in their audit report. So whenever you have certain clauses, please also look at it that there is a consistency in the two clauses also. If you have taken a short-term fund and utilized for long-term purpose, it has to come in E also, it has to come in D also. So this is one of the unique example. I thought I'll share it with you all. Now, internal audit report, whether the company has an internal audit commensurate with the size and the nature of its business. Very simply, very frankly putting it, what you have to do, you have to look at section 138 because internal audit is applicable to certain specified companies only, not applicable to every company. One important point I want to tell you all is that even if the section 138 is not applicable, however, many multinational companies voluntarily go for internal audit, maybe because of their holding company requirements, so on and so forth. If the company has voluntarily adopted the internal audit and they are having a reporting mechanism, then also this clause will be applicable. So it is not only 138, plus the companies which are having an internal audit on a voluntary basis also. That time as well, we need to comment on this clause. And when you say commensurate with the size and, has an internal audit size and the nature of its business, it's very simple that who is doing the internal audit, whether it is in-house or outsourced. If it is in-house, what is the team size? What are the people who are taken for those, internal audits? What is the level of reporting? Whether you are reporting it to the board of director also, what is the frequency of the reporting? And you can look at some of the minutes of the meeting of board of director, or if the audit committee is applicable as well. So what are you trying to understand from here? You're trying to understand the effective functioning of the internal audit system at the company level. Now, there could be chances, and practically telling you, there are, companies which don't want, if there is a third party who is doing an internal audit, they don't want the payroll to be audited by those third party because of the confidentiality issue. Now, if your company is a service company where payroll is the highest cost in the balance sheet, and which is not getting audited by an internal auditor, even though section 138 is applicable. Now that could be one of the issue which you can highlight over here under this clause, that this is one of the significant item which is not getting covered as a part of the internal audit. This is the clause where you can comment upon the reporting aspect also, because many cases what has been seen in the market is that, okay, you would have an internal audit, but these reports are never get placed to the board. I mean, they're just tick in the box approaches kind of a thing. Those things you can comment upon here. And you can highlight that any critical areas, as we are discussing about the payroll, which is not covered. One important point which you can do is that howsoever small is company, if the internal audit is applicable, you can have one meeting with that internal auditor and you can document and you can understand that what is the level of reporting and diligence of checking they are doing it. This is some sample I have put it where there are negative comments in the clauses. Like for example, in the first one, they say that, okay, this is the company has an internal audit system, but the scope to make it commensurate and nature of the business. That means the company need to strengthen this system and widen the scope. Maybe payroll, like for example, which I gave you. The second one is like it requires improvement in scope and coverage. That means, are you covering the entire year? Are you covering the critical process full year? Or they are covered once in 3 years, once in 2 years, so on and so forth. So as an auditor, you can look at the qualitative aspect of the internal audit team or system and you can comment upon here. That is what the expectation is. This is nothing but very simple, that whether you have looked at the audit report, and if you have looked at the audit report, whether you have factored. One important point which I want to highlight to all of you is that the correlation between an internal audit report versus IFC reporting. Be very diligent about it. Before I go there, a statement of fact that if any report is not received, you might call it out, or if it is partially received, you will call it out in your reporting. Now look at this, and this is very important, that you should evaluate the impact of the observation in the IFC report while reporting on the clause on the internal audit report. Now, if you have an internal or IFC FR report, which is qualified report, okay, where you have given a lot of comments that the internal control are not functioning, not effective, so on and so forth. And here, if you come and say that they are commensurate with the size and the nature of its business, they both contradict to each other. So if you have given a negative observation in the IFC FR, obviously, if those observations are not there in the internal audit report, then effectively my internal audit system is not working efficiently. And I need to comment on this clause as well. NBFC, I will quickly discuss because this clause was there last year, earlier also. This is there now also. Now, NBFC, if there's anybody who is carrying out an NBFC activity and has not registered itself, has to be reported under this clause. And also, if there is any plan, because sometimes what happens in some entity, because of one-time income, I might achieve the principal business criteria of 50%. So if there is temporary non-compliances, that can be highlighted with a management explanation and plan that this is a one-time activity, one-time event because of which it has happened. It will not happen subsequently. Exception report is mandatory to be given to RBI if this is a consistent practice of the company. That means you have done 1 year. In 1 year also, the company continued this business activity. So as an auditor, you are supposed to require to, under the master direction of the RBI, required to give an exception report to the RBI and carrying out this business without the certificate of registration. And there are some, you can look at these in the significant audit matter compilation. There are many companies where this kind of reporting has been done. And there are companies where the reporting has been done with the plan also that company will not do such kind of activity in future, etc., also. CIC is very simple. It says that whether you have any CIC, and if you have any CIC, how many CICs you have in the group. So CIC is basically core investment company where mainly it is made for investment in the group. The most important point over here is to identify that whether your company is a CIC and whether you are required to register with the RBI. And if you have more than one CIC, you just need to comment upon there is no violation. There is no restriction on the number of CIC in the group. It is just as reporting on statement of fact. Essay resignation, I will quickly cover the remaining clauses. Essay resignation, one has to be very careful in highlighting the cases wherever there has been resignation. let me tell you, my friend, change of auditors due to mandatory rotation is not covered under this clause. So if you have got appointed due to the rotation of the auditor, that is not covered in this clause. And you need to inquire about the modification or adverse comments in the previous audit report, and you can discuss those during your meeting with the outgoing auditor. One important point which I want to highlight to all of you is this, basically because of the joint audits. Now, if you are doing an audit of a company which is under the joint audit and there is a resignation by one of the joint auditor, then also this clause becomes applicable. The continuing auditor who is continuing should evaluate the reason for resignation by the joint auditor and should report under this clause. So be very, critical, or be very diligent that whenever you are having this kind of a joint audit, and there is a resignation, this clause becomes applicable. Material uncertainty, this we have discussed a lot. I will just quickly tell you that this was requirement under 570 also. This is a requirement which was earlier applicable. You have a very specific clause on material uncertainty relating to going concern. One important point which I would like to highlight to is that there has to be a consistency between the two, right? Consistency between the main report and the CARO report. And we will see some of the examples. Another is that if you have given any commitment or you have given any guarantee behalf of the group companies, and those group companies are not performing well, along with these ratios which are disclosed in the financial statement, you also need to evaluate it tomorrow if this guarantee devolves, whether you will be able to survive for more than 1 year. So it is not only solely based on this disclosure which has been made in the financial statement, but also looking at the other facts and circumstances of the company as well. So don't go blindly by the ratios which have been disclosed, but also if you have given any commitments or guarantee and if they devolve, what will happen to the company? Now, this is the error which I was talking about, very, a silly mistake which is done by many entities. You have a material uncertainty relating to going concern, wherein you're calling that based on these financial statement, etc., we will not be able to continue, or there is a material uncertainty related to going concern. And when you come to the CARO, you say nothing has come to our attention. So let's be very clear that we should be consistent with the main report as well as the CARO report also. And this is how you can report it. This is another example which I put it out, that you can call that out, you can call that para out and say that there are matters which indicate that their material uncertainty exists as on the date of audit report, and the company is not capable of meeting its liability at the date of balance sheet, and when they fall due for a period of 1 year. And you can give a reference to your qualification if you have given any. So be very much careful when you have these kind of clauses in the CARO 2020. This is very simple clause, nothing but a compilation clause, and the last clause under the CARO 2020 is basically if you have given any CSR, CFS audit report, you are reporting upon the consolidated financial statement. So there is no clause by clause reporting. The auditor just have to make a reference on the unfavorable or adverse remark if it has been done by the subsidiary auditor. What principal auditor can do, they can include this in their group instructions, group audit instruction also, saying that please give us the clauses which you feel are adverse in nature, or which are like negative remarks in the nature, which you can simply refer in your audit report. One important point is that let's suppose it is not necessary that all the companies, all the subsidiaries need to be audited before you issue the report. Not possible, because many a times we do we issue a consolidated financial statement report based on the management certified accounts or unaudited books of account also. So as an auditor, one has to do what? One has to report that you have to mention the name of the group company for which the audit reports are not received by the date of the principal auditor. So you have given the CFS, but till then you have not received the report from 5 companies, 6 companies, 7 companies, and you have consolidated based on unaudited financial statement. That fact need to be disclosed. And obviously at the end of the day, it is the audit report of the principal auditor or of the consolidating auditor. He has to apply his professional judgment in saying that which clause I need to report in my CFS report and which clause I need not report in my CFS CARO report. This is how one can give the disclosure. This will be there in the consolidated financial statement audit report, not in standalone consolidated financial statement audit report. And we can say over there, if we don't have any observation, we can simply say that we report that there are no qualification or adverse remark in these CARO report. or if you have any adverse comment or adverse observation, you can call out the name of the company, relationship, SIN number, and you can give the CARO reference clauses also, that this clause of this company has a negative reference or negative remarks. This is another way you can disclose. The third is that if you have not received any company before you have finalized your audit report, you can give the list of the company and their nature and say that we have not been able to get the audit report, and my CARO report does not include these entities which are there. So if you look at typically, now we have concluded the critical clauses which were there. Now we come to the interplay between CARO and Schedule 3. Now there are many clauses which are overlapping, or many points which are overlapping. As you are aware, working capital loan against current asset, we have a limit of 5 crore, whereas there is no limit. Another is, which we discussed, that loan applied for the purpose obtained, we have to comment only on term loan. They have to comment upon all the loans. Other than that, there are many points in the Schedule 3 where there is no corresponding reporting under CARO, like for example, cryptocurrency, struck off companies, layer of companies, so on and so forth. So to be very fair, the Schedule 3 has a more requirement of a disclosure than reporting by the CARO. Obviously, we have multiple clauses to report upon, which may not be directly flowing in the Schedule 3 also. But Schedule 3 has a other disclosure where there is no corresponding clauses in the CARO. My friend, this is one slide which I would like you to specifically focus upon, that whenever you are finalizing any report, please look at these clauses, minimum these clauses. Reporting on reconciliation or discrepancy for loan against current asset, these are high risk or critical clauses, because this is a potential area of a fraud. Terms and condition of the loans crucial to the interest of the company, because this requires dual reporting. Evergreening of loans, because this is seriously under regulatory watch. Loan utilized for purpose other than taken or short-term versus long-term, diversion of fund, and reporting on going concern. These are high-risk clauses which any auditor, if it is present in your audit report, should critically look at it and evaluate it. These are some of the points from the FRRB report which I have just picked up. I would quickly discuss one or two only. Like for example, interest-free loan to subsidiary which has been given. There is a disclosure about the financial weakness of the subsidiary at the time of loan given. There is a loan default by the company itself. That means the company which has, I'm talking about the second bullet basically. The company itself has defaulted in repayment of these loans, but has not called these loans as prudential to the interest of the company, what I've given it to the subsidiary. So there's a contradiction in the reporting. You know that the financial weakness is there of the subsidiary. You know that the subsidiary is loss making, etc. But still you have not called these loans as a prudential to the interest of the company. Then again, there is a term which has been used by the auditor like material fraud instead of any fraud. All frauds need to be required to be reported by the auditor. That is what the FRRB observation which is there. In case of loan recalled by the bank, so this clause relates to where the auditor has to give the details of the defaults made by the bank basically. So what this clause is saying, that in case the loan is recalled by the bank, when the bank recalls the loan, the total amount becomes a due, and not only the principal which has been as per the repayment schedule, which has become due as per the repayment schedule. So very important observation by the FRRB, that if the loan is recalled by the bank, entire amount has to be disclosed as a default and not only the amount due till date. I mean, you can look at these reports. There are many such observations on the CARO issue. Another is that section 187 and 177 and 188. They have just reported that the company has complied with section 177 and 188, but the clause requires you to comment on accounting standard also, which was not commented upon. So there is a non-compliance basically. This is the observation of the FRRB, NFRA, my friend, which has been listed down. This is just for your information. NFRA has highlighted major lapses through their 1617 order, which have been issued since last 2 months. There are failures with respect to the inventory, verification of the inventory. There are failures to identify the related party transaction. There are failures with respect to determining the arm's length pricing, and the point which we were discussing about the evergreening of loan through structured circulation of the funds. Lapses relating to going concern basis of accounting. Now, if you look at these all points, you can easily correlate with the amendment which has been done in the CARO 2020. So this is getting originated from the lapses what the NFRA is finding out, or the RBI what they are observing as their part of their review. So this is what I wanted to cover, my friend, and I will just end up my presentation with this quote of past president of ICI, which says that audit is a very serious business. Stay away from it if you can't meet the expectation gap. Thank you so much, AASB, for giving me this opportunity. And if there are any questions, I'm happy to take them.
Thank you so much, sir, for such a detailed and very nicely elaborated presentation on CARO. I have gained a lot through your deliberation. Hope our members have also gained a lot through your deliberation. You have spent more than 2 hours continuously on this topic. So thank you so much, sir, for sparing your valuable time and this showing and enlighten all of us various clauses of the CARO. I have received certain queries of the members. If you permit, may I ask those queries also?
Sure.
Yes, sir. Sir, when the due is not outstanding pursuant to the CIT appeal order, department filed appeal with ITAT. Whether the disputes raised by the department required to report it in CARO in spite there is no dues.
So if there are no dues, there is no requirement to report upon. Only if there are dues which are outstanding as on the balance sheet date, then only it is required to be reported upon.
Okay, sir. And in the due course of audit, it is observed that consumption of raw material is not recorded properly. However, the stock as on balance sheet date has been physically verified and balance is prepared according to the physically verified stock. So how to handle this in the report? Kindly guide us, sir, in this regard.
Sure. So this has a multiple aspect. One is that if the consumption has not been recorded, the cost which is coming for the on the P&L side with respect to the while determining the GP margin may not be accurate. One, what we can do is that you can call this out, may not be specifically in the CARO report because there is no separate requirement to report upon, but definitely you can call it in your IFC report, which is there on the internal financial control. Now, this is one of the significant item in my financial statement, the consumption of the raw material, because it's close to the P&L. So not in the CARO, but you can cover it in your main IFC report also.
Yes, sir. Sir, how to report on fixed assets verification? Also, where assets are idle and no depreciation charge, how to report the same in the CARO?
So fixed asset verification is depending upon the company at what interval they are doing. If they have not using these assets and these assets are sitting ideal, still, even though you have not claimed a depreciation, but still the fixed asset verification need to be conducted because they are sitting in your balance sheet as an asset in the books of accounts. They are there on your asset side of the balance sheet. So you have to carry out a verification. And if this verification has not been carried out by the management, as an auditor, you comment upon saying that in respect of these assets, which are ideal, the management has not carried out the verification during the year or during the period of, or as per their plan also.
Yes, sir. So regarding the clause on working capital, should a confirmation of the returns filed by the borrowing company be obtained from the bank or by the or from the company?
So normally what happens whenever you submit these stock statement or these book debt statement, etc., there is an acknowledgement which is given by the bank. And if you have the return or the statement which is acknowledged by the bank, that should be factored in. There is no independent confirmation which is given by the, any banker with respect to this statement. Unless and until, you take an authority letter and go to the bank, say that please certify this stock statement. However, as a practice, all the banks give an acknowledged copy to the borrower whenever they submit these stock statements.
Yes, sir. So assets reported under right of use under property, plant and equipment schedule, but where the company has only a share certificate and allotment letter from an associate to demonstrate title. No agreement held on record. Should such cases also be reported under this clause?
So I think there is a very specific exclusion from the clause itself for the lease arrangements. So if you look at it, the lease arrangements are specifically excluded. So if you have a lease arrangement, I don't think so you are required to report under this clause. If you have let's suppose you have a property on which only a share certificate has been received and no other title document is there, the share certificate should be in the name of the company. If it is not there, it will come under this clause, not under the lease arrangement, under the under the outright purchase arrangement.
Yes, sir. Yes, sir. So another question relating to the holding company, where the holding company takes loan from the bank,
Anilji, I
should
can't
we
hear you.
state this fact under this clause?
Anilji, you have to repeat. You have to repeat, sir.
Now you can hear me?
Yeah, please,
Now
please.
you can hear me?
Please,
So
please.
where the holding company takes term loan from bank, stating for business purpose and transfers money to other subsidiaries, should we state this fact under this clause?
So what happens typically, that many banks give this kind of a general corporate purpose loan also to many entities. Now, this general corporate purpose loan cannot be used for the purpose of acquisition or transferring this money to the subsidiary. So if it is a general corporate purpose loan and the money has been diverted to the subsidiaries, etc., the fact can be reported in the CARO clause.
Yes, sir. If CARO is not applicable to a company, however, the auditor is in the opinion that loans and advances are prejudicial to the interest of the company, how is the same reported in the main audit report, sir?
So there is a specific section 143(1)(a), I think I covered in my presentation, wherein the auditor as a duty bound has to evaluate these conditions, and if he finds any negative remarks, he has to comment upon it. So if you have, even though CARO is not applicable to your company, but you feel that these loans are prejudicial to the interest of the company, you can go ahead and report upon under that clause.
Okay, sir. So whether the amount mentioned in SCN needs to be reported?
Whether the amount made in SCN with respect to, what I can understand, this is with respect to the statutory dues clause, because willful defaulter, there is no amount which is mentioned basically. So if there is a show cause notice, the show cause notice need not be recorded as a dues or as a disputed dues itself. So you don't need to mention about show cause notice.
Okay, sir. Sir, current account maintained by the government company and signatories retired more than 10 years ago, and bank current account become the inoperative. So current directors have no knowledge. So audit fees paid by the holding company. Sir, what should it to be reported in this case?
I think this is outside the CARO purview only. I mean, this is a business transaction. Yeah, this is a business transaction. This is outside the CARO purview.
Yes. I'll forward to you, sir, and respective this feedback we will send to the member.
Sure, sure.
Sir, one is in case of the first time adoption of Ind AS, the ROU will be created only in current year. Does amount to revaluation, which is to be reported under CARO?
No, it is not. The revaluation is only of property, plant and equipment and intangible asset.
Yes. Same in continuation, some small companies were never ever maintaining any type of mandatory register. What is the remedy or solution to this? What should we suggest to the management as a consultant, not as an auditor, as far as the CARO reporting is concerned?
See, I would suggest very frankly that, and this is, I mean, this whole session on CARO is basically for the auditor. But even if the consultant has to give the advice, they can refer the guidance note. The guidance note gives a very detailed guidance on how the fixed asset register can be maintained, what should be the particulars in the fixed asset register, and the management has no other choice to maintain these registers. And they have to, incorporate all the details. And this is not only relevant for the purpose of the audit, but this is also relevant. Let's suppose tomorrow, this company goes for any other kind of an expansion plan. This kind of documents or records are important. Tomorrow, if there is a due diligence which is done by any other company for takeover of this entity, or there is an investor which is coming in, these are the basic documents which anybody looks at it.
And so CARO was applicable in last year only, and accordingly it has been reported. But as per the increased limits of small company, CARO is not applicable for current year. Is that auditor required to report on CARO just because of it was given last year?
No, not required. No, CARO is a year-wise year reporting. If it is not applicable in the current year, I will not report it. If it is applicable in the next year, I will again report it. It is year-by-year reporting.
Okay, sir. Okay. So last question. CARO is the main part of the audit report or as an additional requirement, sir?
So this is the main part of the audit report, because as I said in my start of the presentation, there is section 143 under which the auditor is required to report upon the company. Now, subsection 11 of that section says that the central government will issue an order, which is called as a company auditor's report order, under which I need to report upon. So it is a part of the main audit report, but submitted as an annexure to the main audit report. So if you look at it, there is a clause which comes in the main audit report also, and then we give the annexure. So it is a part of main audit report.
Yes, sir. Yes, sir. One more question pop up, sir. Where the borrowings of the company is at the rate of 12% and giving of loan to a third party is at the rate of 11%. Whether the same can be set to the prejudicial to the interest of the company as far as the CARO is concerned?
Many times what happens, and I get his question from where he's coming. Many times what happens, you have a supplier, okay? The supplier to your company also needs certain funding. Now you have not given any advances because you don't want to give interest-free advances to them. What you have given this kind of a loan at 11%. Now, if it has some business logic attached to this loan of giving this 1%, charging 1% less, then you can understand. And as I said during my presentation also, each case need to be looked at it differently and then comment upon. If the company has a very justified reason why this has been given at 11% and not at 13% to on a 1% margin, and if the auditor is, agreeing to the business logic what has been given, they can go, they can move ahead and not report it. But if it is purely a lending activity which has been done by the company, then 100% this is prejudicial to the interest of the company.
Yes, sir. Yes, sir. Now we come to an end, sir. Thank you so much once again on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India for sparing your valuable time and enlighten all our members as well as all of us on various intricacies, clauses mentioned in the CARO 2020. Thank you so much, sir, for sparing your valuable time.
Thank you.
And for
Thank
the
you. Thank
wonderful,
you so
wonderful deliberation, sir. Thank you so much.
Thank you,
Thank you, sir. Thank you.